Let's begin by looking and perhaps getting from you a sense of the state of Kenya's balance sheet, if you like. With a budget deficit of around 6.8% of GDP, clearly it's not as bad as we have seen in the more developed countries.
No, it is not as bad as we've seen in more developed countries, you're right. It is high by Kenya's standards because we're used to at most 4% deficit out of GDP. But you must remember that we are coming out of a counter-cyclical expenditure cycle in which we are spending more through a stimulus package in order, following the 2008 crisis, not to let the economy slip.
Is that money being
so definitely, that's very likely is going to fall.
Yeah, but is that money being spent in the right areas for you?
I think it is being spent in the right areas. Come to think of it, most of Kenya's public money is actually now going to education, the single most important area of expenditure. And second, public health. And thirdly, infrastructure. Infrastructure has been neglected for a very long time. Most of it is being funded from local sources through investment bonds and that sort of thing. So I think the government has got its priorities right. The difficult point is to know when to call off the stimulus so that you can go back to tolerable and sustainable deficits of the order that we have seen in the past.
Yeah. Currently, we have an external debt burden, at least of the percentage of Kenya's external debt versus compared to the GDP of around 21%. That's not very onerous, but this reliance on the domestic market for funding what you've just been described now, is that the right strategy, do you think?
Well, I think it's a balance between local, external, but at the end of the day, what you're really looking for is long-term borrowing, which is redeemable over longer periods and at lower interest rates. This is the case when the government has gone into the domestic market to borrow for infrastructure. All the bonds have been oversubscribed, the latest one by as much as 30 or 40%. So there is liquidity there. It's the right way to go. What the government has to make sure is that all that infrastructure, all that expenditure on human investment is going into productive areas so that the economy is producing or rising in future at a rate that sustains redeeming of those debts.
But is the balance right at the moment? In other words, could the government perhaps be tapping international markets more for the borrowing that they are needing now, rather than focusing so much on the domestic market, before we talk, of course, about what effect that is having on the domestic market?
Actually, just before the global financial crisis in 2008, the government of Kenya had set itself quite ready to go into the international money markets for long-term bonds, the very first one. All the plans had been made. The government was about to go, as you know, were Ghana and I think Uganda and some other African countries. The crisis put paid to all those preparations. So what the government is doing and was doing then is to tap into the liquidity into the domestic market using the Nairobi Stock Exchange and to make sure that the borrowing is long-term and of lower interest. And I think they're doing that. And by the way, we're already preparing for entry into the international money markets as soon as that can be arranged. So it's going to be both. It's going to be a balance.
Would it not be correct then, or the right decision now, to go internationally, given the fact that we've got international interest rates at such low levels?
In fact, that is what I said. We are already made plans to go into the international money markets for long-term development bonds as far as Kenya is concerned. That is already, the plans are very advanced, and you're going to be getting news of that pretty soon. It's going to be a test thing because we have not done this for any length of time in the past. So we're testing the market. We're going to see how we land, because just because interests are low out there does not mean that the Kenya bond is going to be purchased at low interest rates. We're testing the market. We'll see how that goes, and then we'll keep expanding our capacity to tap into it. But as I say, don't forget also that there's sufficient liquidity in the Kenya market, which you cannot overlook. If we don't take it, somebody else will.
Absolutely. Certainly, let's come back and look at that domestic market. Now, we know the government has been very active in the domestic market and has raised quite a large amount of money. Has that not had the effect of crowding out the private sector, if you like, and also putting pressure on the local interest rates? Can you hear me, Professor Chege? We seem to have lost Professor Chege. Lumkile, let me come to you. The question I'm putting to the professor is that we're seeing the government very, very active in the domestic market. But at the same time, we do know that if you concentrate all your money raising on the domestic market, you do have the effect of crowding out the private sector and putting pressure on your domestic interest rates. Is Kenya not suffering the same?
Well, Kenya, given its very much little exposure to global markets, particularly in terms of its exports, it's got much more liquidity, as the professor is saying. Therefore, it can afford continuing to mobilize domestic savings by tapping on those savings. However, I think, as we're indicating, the strategy is to try to diversify that, because as soon as the global environment changes and as soon as that strategy matures, because Kenya, Uganda, there's a huge focus around downstream beneficiation and strengthening the manufacturing sector for exports. And therefore, when that process becomes much deepened, they may need now to really be serious about getting offshore funding for their capital requirements.
Yeah, let's look at the numbers, because the numbers that I have here show Kenya may repay as much as 68 billion shillings in domestic interest rates versus 7 billion shillings for external debt. That looks like the difference is huge.
Yeah, but it's very nice for if you're holding a government stock in Kenya. It's very nice, because then you find yourself that with liquidity, you can look for other opportunities with small, medium enterprises and other areas. So it's quite a very vibrant environment at the moment. And if I was the Kenyan government, I'd be very, very happy, given the fact that I don't have to be going to international markets, despite the fact that as a strategy, it's nice to diversify so that you don't put your eggs in one basket.
Yeah. Now, in 2005, they were setting aside as much as 22% in budget allocations for debt repayment. And now, I would assume now that number probably would have improved. But 22% of all your budget, allocated 22% of your budget allocations for debt repayment, that's quite a large amount of money.
It's quite a large amount of money, but compared to the South Africans, who are running closer to, at the moment, to 50% government debt GDP, it's nothing in comparative terms. However, the challenge the process is saying is that how has the money been used that was borrowed? So quite importantly, if that money is paying itself off, it's usually useful to borrow, because it's cheaper to borrow than use your money for other things. So it makes sense for government to go and borrow, as long as it's being invested on infrastructure, it's being invested on human resource development, and the quality thereof that human resource development. Because we know that investing on education, a country like South Africa spends more than any other country in education, but you know that the output is extremely poor. Therefore, the return on investment is negative until something is done. Very much we'll have to look at how best we can use that money. And the Kenyans may find themselves in that trap. So I hope that the expenditure on education, the return to government is positive, so that they don't look like South Africa going forward. Yeah,
Professor Chege, before we go to cut off, the question that I'd put to you was the amount of money, the large amount of money that Kenya is paying in foreign payments versus that it is paying on the domestic market. In fact, the numbers that I have here show 68 billion in interest to domestic debt repayments versus 7 billion shillings for foreign. Is that not quite a large amount of money to be spending just on your repayments?
No, you have to look at the structure of the country's public debt. Firstly, most of the money that is being paid, that has been borrowed from outside, has actually come from multilateral development sources, principally IDA of the World Bank, the African Development Bank, the European Development Bank, and that sort of thing. It's low interest rates, and that is why, comparatively speaking, it does not look like a huge amount to redeem. What has happened, though, in the last 5 or 6 years or so, is that the government has also turned increasingly into the domestic market for borrowing, having realized there's a lot of liquidity. The government lowered the cash reserve ratio, so there was a lot of liquidity in the market because the economy was growing, and has seen an opportunity in which it can borrow long term, which didn't do that before. We think that at the moment, the amount of borrowing that's been done domestically is sustainable. And the fact that the IMF and the World Bank and all those who have looked at African debt forgiveness have bypassed Kenya is that they think that Kenya is not debt stressed. So there's been no talk of debt forgiveness in this country.
Are we beginning to see returns coming through from some of that investment? The point that Lumkile here in the studio was raising is that as long as that money is being spent wisely, the returns will more than make up for the money that you're spending in. Is that money going in the right areas, and are the returns beginning to come in?
I very much agree with this concern. In fact, the real test is whether the money is being spent. A lot of concentration has been focused in the press and in the NGOs in this country on the size of the debt. That's not important. It's where it's going and whether that expenditure is going to yield growth, job-creating growth, expanding the economy and expanding opportunities for Kenyans. So far, so good. We cannot tell 10, 15 years from now, of course too long, but in the short run, where we are talking about over 5% growth rate this year, and even higher that year, and picking up the year after that. And that applies to predictions coming out of the World Bank and the IMF and ourselves. So this is positive. Kenya's real difficulty is that the growth that we have experienced in the past has not been as encouraging in job creation as it has been in profits and returns in the stock exchange and that sort of thing. We must make sure that there is a deliberate bias to job creation because we have a young, like most African countries, a young and educated population, and we cannot afford to have them unemployed in great numbers.